Is your bank in danger of failing? And here's how to check. Recently, the stability of our banking system has been a hot topic in the news. From sudden bank closures to government interventions, it's natural to wonder, isn't it? How safe is my money? Which banks are in danger of failing? Today, we're diving into this complex and crucial subject. Welcome back to the channel, folks. I'm Dave Seymour, and today we're exploring the factors that contribute to bank stability and how you can assess the health of your own bank. We'll explore the key indicators that financial experts use to assess the bank's health, recent trends in the banking industry, and what it all means for you as a consumer or investor. We'll also provide you with tools to make informed decisions about your finances. Before we dive in, let's make one thing clear. The purpose of this video is not to cause alarm or point fingers at specific institutions. Instead, we want to educate you on how banks operate, what can put them at risk, and how you can stay informed about the health of your financial institutions. Let's start by understanding what it means for a bank to fail. A bank failure occurs when a bank is unable to meet its obligations to its depositors and others. This can happen for various reasons, which we'll explore in a moment. But when a bank fails, it's typically closed by a federal or state banking regulatory agency. Now, let's look at some key factors that can put banks at risk. Asset quality. The first factor is the quality of the bank's assets. Banks make money by lending out deposits and earning interest. If too many of these loans go bad, meaning borrowers can't repay them, it can spell trouble for the bank. During economic downturns, the risk of loan defaults increases. This is why you often see more bank failures during recessions. Banks with a high concentration of loans in troubled sectors or regions, well, they can be particularly vulnerable. One key metric here is the non-performing loan, NPL ratio. This means the number of or the amount of loans that are in default or close to default against the bank's total loan portfolio. A high or rising NPL ratio, well, that can be a red flag. Liquidity. The second factor is liquidity. This refers to the bank's ability to meet its financial obligations, like customer withdrawals, as they come due without incurring significant losses. A bank needs to have enough cash or assets that can be quickly converted to cash to meet depositors' withdrawal demands. If too many depositors try to withdraw their money at once, what's known as a bank run occurs, and even an otherwise healthy bank can face a liquidity crisis. This is why confidence in the banking system is so crucial. The liquidity coverage ratio, LCR, is a key metric here. It ensures that banks have enough high-quality liquid assets to survive a 30-day stress scenario. A low LCR could indicate vulnerability to a bank run. Capital adequacy. The third factor is capital adequacy. This is essentially a measure of a bank's financial strength. It is the bank's cushion against potential losses. Regulators require banks to maintain certain capital ratios to ensure that they can absorb unexpected losses without becoming insolvent. The most commonly cited is the Tier 1 capital ratio. This measures a bank's core capital against its risk-weighted assets. A higher ratio indicates a stronger capital position. Now, in the wake of the 2008 financial crisis, regulators increased capital requirements. Most large banks now maintain ratios well above the minimum requirements. However, banks with a capital ratio close to or below regulatory minimums, well, they're more vulnerable to economic shocks and may be at a higher risk of failure. Interest rate risk. The fourth factor is interest rate risk. Banks make money on the spread between the interest they pay on deposits and the interest they earn on loans. Rapid changes in interest rates can squeeze this spread, potentially leading to losses. In particular, banks that rely heavily on short-term funding but have a lot of long-term fixed-rate loans, well, they can be vulnerable when interest rates rise quickly. Earnings and profitability. A bank's ability to generate consistent profits is crucial for its long-term viability. Metrics like return on assets, ROA, and net interest margin are important indicators here. Declining profitability can be a warning sign, especially if it's due to fundamental issues rather than temporary market conditions. Now that we understand these factors, let's look at some recent events that have put bank stability in the spotlight. In 2023, several U.S. banks, including Silicon Valley Bank and Signature Bank, collapsed. These failures, they sent shockwaves through the financial system and raised questions about the health of other banks. The Silicon Valley Bank failure was particularly notable. It was primarily caused by a mismatch between the bank's assets and its liabilities. The bank had invested heavily in long-term government bonds. Now, when interest rates rose quickly, the value of these bonds fell, creating a hole in the bank's balance sheet. At the same time, many of the bank's depositors, mainly tech startups, began withdrawing funds, creating a liquidity crisis. These events have understandably raised concerns about the broader banking system. However, according to the FDIC's latest quarterly banking profile, the overall banking industry remains on solid footing. Most banks are well capitalized, meaning they have strong capital ratios. However, the report also notes some challenges, including narrowing net interest margins and increasing non-current loans in some sectors. Analysts have pointed out that smaller and mid-sized banks might face more pressure than their larger counterparts. This is partly because they often have less diverse deposit bases and loan portfolios, making them more vulnerable to regional economic downturns or troubles in specific industries. There's also been discussion about banks with high exposure to commercial real estate, particularly office properties. With the shift to remote work, there are concerns about the long-term value and income potential of office buildings in some markets. Another area of focus has been crypto-friendly banks. The volatility of the cryptocurrency market and the collapse of some major crypto exchanges have put these banks under increased scrutiny. So, how can you assess the health of your own bank? Here are some steps that you can take. Check FDIC insurance. First and foremost, make sure your deposits are FDIC insured. The Federal Deposit Insurance Corporation, FDIC, insures deposits up to $250,000 per depositor per insured bank for each account ownership category. This means that even if your bank fails, your insured deposits would be safe. Research your bank's financial health. You can find financial information about your bank on the FDIC's website. Look for key ratios like the bank's Tier 1 capital ratio, a measure of its core capital compared to its risk-weighted assets, and Texas ratio, a measure of its credit troubles. While these ratios can be complex, generally higher Tier 1 ratios and lower Texas ratios are better. Diversify your deposits. If you have deposits significantly above the FDIC insurance limit, consider spreading your money across multiple banks. This ensures all your deposits are fully insured. Stay informed. Keep an eye on financial news, particularly any news related to your bank or banks in your region. Be wary of rumors or unverified information on social media, which can sometimes spark unnecessary panic. Understand your bank's business model. Some banks focus on traditional retail banking, while others may be more involved in riskier activities like investment banking or trading. Understanding your bank's business model can give you insight into its potential vulnerabilities. And remember, while it's important to stay informed and take prudent precautions, it's equally important not to panic. Bank failures, while serious, are relatively rare events. Most banks are stable, well-regulated institutions that play a crucial role in our economy. It's also important to remember that the U.S. banking system as a whole is much stronger than it was during the 2008 financial crisis. Regulatory changes have improved capital requirements and risk management practices. If you do have concerns about your bank, don't hesitate to reach out to them directly or consult with a financial advisor. They can provide personalized advice based on your specific situation. Understanding bank stability is complex, and it's important to remember that no one can predict with certainty which banks might face difficulties in the future. The best approach, as always, is to stay informed, diversify your assets, and ensure your deposits are protected by FDIC insurance. We've covered a lot of ground today, and we want to hear from you. What steps do you take to ensure the safety of your deposits? Are there any aspects of banking health you'd like us to explain further? Drop in a comment below and let us know. And if you found this video helpful, please give it a thumbs up and subscribe to our channel for more insights on personal finance and economic trends. And don't forget to hit that notification bell so you never miss an upload. Until next time, stay informed, stay calm, and make wise financial decisions.